Ever wonder why Turkey has been home to one of the most turbulent major economic crises in the world over the last 2 decades? Inflation has been the headline issue in the country for the past 5 years, reaching 53.9% as of 2023. Despite Western banks re-entering the Turkish market and Turkey replacing the old Turkish lira with a new currency in 2005, the current account deficit is still climbing, hitting 44.9 billion in 2023. So what are the factors driving Turkey's current economic crisis? Why has it been unable to control inflation, and what realistic solutions does it have left to stabilize its economy? Since the 1990s, Turkey has been experiencing wild economic growth thanks to some clever reforms. Its economy grew at an average of 5.4% per year between 2002 and 2022, which meant that people's incomes more than doubled during that time. In 2004, its annual GDP growth rate hit 9.8% and reached an all-time high of 11.4% in 2021. Having recorded an annual lowest of negative 5.8% in 2001, Turkey's GDP grew by 4.5% in 2023, with its growth projected to slow down to 3.0% this year before picking up speed again in the years that follow. However, the rise of President Recep Tayyip Erdogan has caused an economic shift in Turkey. For example, in 2017, Turkey pulled a clever move by using its Credit Guarantee Fund, a tool originally meant to help small and medium businesses to supercharge credit expansion. But with all that economic growth came a downside: massive current account deficits. The country's current account deficit jumped from $22.2 billion in 2016 to $44.9 billion in 2023. But how did Turkey's credit expansion and economic growth lead to a massive current account deficit? As the money circulating in Turkey's economy grew, the money is used to meet the increasing domestic demand, causing a spike in imports. This increase in imports widened the current account deficit. On top of that, Turkey relied heavily on continuous capital inflows to finance its already large deficit. This made the economy sensitive to global risks, leading to wild swings in exchange rates and boom-bust cycles in economic activity. Meanwhile, amidst all this, the Turkish lira felt the squeeze, leading to rapid depreciation. How has Turkey's current account deficit affected inflation and the lira's value? Because Turkey relies so much on foreign capital, any disruption in these inflows sends the lira into a decline. When the lira loses value, the cost of imported goods shoots up, which only makes inflation worse. From 2019 to 2023, the lira depreciated substantially. For instance, in 2019, 1 USD equaled approximately 5.3 lira. By 2023, the rate had worsened to around 30.2 lira per USD. This means that the percentage drop in the lira's value against the USD is approximately 466% over this period. Nonetheless, every dip in the lira has been matched by a spike in inflation. It's a vicious cycle. The weaker the lira gets, the higher prices climb, showing a clear link between the exchange rate and inflation, a sort of purchasing power parity in action. Because of this, Turkish banks and big companies started borrowing foreign currency. But why borrow in foreign currency? Despite the risk, the interest rates were way lower than borrowing domestically, so it seemed like a smart move, until the Turkish lira started depreciating drastically. This is where things got tricky. The rapid depreciation of the lira made paying off that foreign debt way more expensive, putting the banking sector and non-financial companies in a tight spot. But it wasn't just about getting cheaper loans. Borrowing in foreign currency also fueled a credit boom in Turkey. Banks were borrowing in dollars and euros to fund their lending, even when they were lending in Turkish lira. This created a perfect storm. As the lira's value swung wildly, the risk stacked up, leaving the economy more vulnerable to currency fluctuations. Speaking of Turkey's currency fluctuation, the decision to change the old Turkish lira in 2005 to the new Turkish lira seems to have not solved the economic crisis, especially with the crazy high inflation they had been dealing with. So why did Turkey decide to swap out its old currency for the new Turkish lira? Well, let's rewind a bit. From the 1970s through the 1990s, Turkey was in an inflation nightmare. Prices kept skyrocketing, and by 2001, the old lira had taken a massive hit. The old lira became pretty much useless for everyday stuff because the numbers were just too big. To fix this, the Turkish government decided it was time for a currency makeover. In late 2003, they passed a law to remove 6 zeros from the old lira, giving way to the new Turkish lira. This new currency wasn't just about easier math. It was a way to restore some sanity to the economy. By making transactions simpler and improving the currency's image, the new Turkish lira helped to stabilize things and gave people a little more confidence in Turkey's financial future. But things didn't change very much over the years. Moreover, one big reason for Turkey's economic troubles starts with President Erdogan's unusual ideas about interest rates. He's made it clear he hates interest rate hikes, even calling them the mother and father of all evil. This belief, tied to his Islamist views, led him to block the central bank from raising rates when it needed to. What was the result of his action? Inflation skyrocketed, hitting a 24-year high in 2022. Specifically, the annual inflation reached a high of 72.3% in 2022, driven by the crash in the Lira since 2021 and soaring commodity prices. But why the inflation? Erdogan was convinced that keeping interest rates low would magically reduce inflation. So, he kept slashing them, even when prices were going through the roof. During his presidency, especially in 2021, things got really messy. He replaced central bank chief Naci Agbal with Sahap Kavcioglu, who shared his low-rate obsession. The new chief quickly dropped interest rates from 19% to 14%, and just like that, the Turkish lira lost nearly half its value in 2021 alone, 44% to be exact. By May 2023, Erdogan quickly U-turned after winning the elections, appointing Mehmet Şimşek as his finance minister and Hafizagay Erkan as central bank governor after he was re-elected. Both Şimşek and Erkan were considered safe hands. They both made it clear that they disagreed with Erdogan's unorthodox monetary policies, and they both spent a lot of their careers at big Western banks. As expected, they started raising rates soon after being appointed. Interest rate rise from 8.5% to 45% by early 2024. What happened next? Did the rate raise impact inflation? Fair enough, the rate hike led to a positive reaction in the financial markets, with the Turkish lira rallying against the dollar and Turkey's dollar bonds extending their rally. Despite the rate hike, inflation remains a significant challenge. The central bank has committed to keeping a tight monetary stance until they see inflation take a serious decline. But this hasn't been enough to get Turkey out of its economic issues. Now let's talk about Turkey's energy dependency problem, which is hitting hard on the ongoing economic crisis. For example, the cost of basic necessities like food skyrocketed by nearly 70% as of January 2024 compared to the year before. Why the surge? Turkey is heavily dependent on imported raw materials, which means higher costs for fuel and everyday goods. Here's the real issue. Turkey's energy dependence is massive. For 2 decades, the country's energy needs have been growing and will keep climbing until at least 2035. Turkey is known as one of the top massive energy consumers, and in 2022, it ranks 16th in the world for primary energy consumption, beating out countries like Italy, Spain, and even Australia. Between 2001 and 2021, Turkey's energy consumption more than doubled, making it the fastest-growing energy user in the Organization for Economic Cooperation and Development. With its growing population and economy, this trend isn't slowing down anytime soon. In fact, experts predict that by 2050, Turkey's electricity demand will jump another 55% compared to 2022. But Turkey doesn't have the natural resources. It imports almost all of its energy, 93% of its oil and 99% of its gas, both priced in dollars. And with the lira losing value, those costs are only getting worse. Speaking of oil and refined oil products, they are Turkey's second biggest energy source, and they're a huge piece of the puzzle when it comes to the economic crisis Turkey is facing. For the past 30 years, oil demand, driven largely by the transportation sector, has been on the rise. But just like with natural gas, Turkey is heavily dependent on oil imports, with local production covering less than 10% of its annual needs. And guess who's the main supplier? Russia is Turkey's biggest trade partner for these energy imports, which makes things even more complicated. Most of Turkey's oil comes from Russia, delivered by ships sailing from the Black Sea ports of Novorossiysk and Supsa to Turkey's Mediterranean coast. Fun fact, about 3% of the world's oil trade passes through the Turkish Straits, giving Ankara some leverage in its dealings with Moscow. These ties with Russia, combined with global sanctions and shifting dynamics, play a big role in shaping Turkey's economic landscape. Meanwhile, in 2022, Russia became Turkey's largest trading partner, with trade between the two nations doubling to $68.2 billion. This trend likely continued into 2023, and as a result, Turkish companies caught supplying technology, goods, and services to Russia found themselves slapped with sanctions. As global political shocks keep shaking things up, Turkey is holding on tight to its key commercial partnerships while navigating the ever-changing geopolitical maze. But Turkey's trade future is partly tied to the sanctions on Russia, making the situation as uncertain as a coin toss. On the economic front, Turkey's new finance minister and central bank governor are on a mission to tackle the country's current account deficit, which hit $44.9 billion in December 2023. Energy is a massive and costly chunk of Turkey's budget, and it's a big reason why the country's finances are often in the red. Over the past decade, Turkey's current account balance was negative every year, except for 2019. But without energy costs, Turkey would generally show a surplus. In 2022, the impact of energy imports hit a new high. Turkey's energy bill for that year was $97.1 billion, leading to a record energy trade deficit of $81.1 billion, nearly doubling from $42.4 billion in 2021. This spike was fueled by the sky-high energy prices that followed Russia's invasion of Ukraine, with natural gas prices alone rising by 310% in just 1 year. Now, if you think Turkey's energy dependence problem is the only factor fueling its economic crisis, consider its export trades. Turkey is still importing way more stuff than it exports. This is a bit of a shock because usually a depreciating currency forces a current account readjustment. After all, if your currency is declining, your imports should become more expensive, while your exports should become more competitive, which means less imports and more exports. Unfortunately for Erdogan, however, that's not what happened, largely because Turkish exports have now been stagnant for the last few years. The country's exports fell to $8.98 billion as of April 2020. In December 2023, they were a little bit better but still very poor, reaching $23 billion. Germany topped the list as Turkey's main export partner, raking in over $2 billion, followed by the United States, Italy, the United Kingdom, and Iraq. Mustafa Gultepe, the president of the Turkish Exporters Assembly, pointed out that the weaker export performance was due to the sluggish demand from Europe, Turkey's biggest customer, taking in about 50% of its exports. Despite Turkey's exports seeing a positive jump as of July 2024, reaching $22.5 billion, they face a serious warning from the U.S. Washington has put Ankara on notice, telling them to cut off their exports of U.S. military hardware to Russia or else. Matthew Axelrod, the U.S. Assistant Commerce Secretary, recently met with Turkish officials to tackle what he calls Ankara's illicit trade with Moscow. His message was clear. Turkey needs to stop the flow of microchips and parts to Russia that could be used in the war in Ukraine. We need Turkey to help us stop the illicit flow of U.S. technology to Russia, Axelrod said. We need to see progress, and quickly, by Turkish authorities and industry, or we will have no choice but to impose consequences on those that evade our export controls. He called it an urgent problem and pushed the Turkish government to adopt and enforce a ban on the transshipment of U.S.-controlled items to Russia. The U.S. is worried that Turkey has become a gateway for Western-made electronics that end up in Russian missiles and drones, violating sanctions. But beyond the export of foreign trade, Turkey is facing a big financial investment hurdle in 2024. The country needs to secure a hefty amount of cash to cover its external debt payments and current account deficit. We're talking about $200 billion in debt payments and a current account deficit of around $35 billion. That's a mountain of money, and figuring out how to get it is a major challenge for the government. These financing problems aren't just numbers on a spreadsheet. They're hitting Turks hard every day, especially students. With money tight, many young people are switching to remote or evening classes because they need to work during the day just to make ends meet. Some students are even dropping out entirely to work full-time and support their families, who are teetering on the edge of poverty. The economic pressure is pushing skilled workers to look for better opportunities in more stable European countries like Germany, leading to a brain drain that could seriously hurt Turkey's future economy. So, with all this chaos, the big question is, where does Turkey go from here? Before we get into the last part of the video, make sure to check out the link in the description for my best recommendation when it comes to further expanding our knowledge on a more personal scale. September 2023 was a game changer for Turkey. President Erdogan finally changed his tune on interest rates, something he'd been against for ages. Realizing the need to tackle sky-high prices, he announced Turkey would embrace tight monetary policies. This move is aimed at rebuilding confidence and stability in the economy. Since then, interest rates have shot up 8 times, now hitting a whopping 45%. While some folks think this might not fully undo the damage from the central bank's previous lenient policies, there's a glimmer of hope. December 2023 saw inflation at 64.8%, just shy of the expected 65.1%, hinting that things might be turning around. Despite hiking rates from 8% to 50%, inflation has continued to rise, reaching a recent high of 75% year-on-year in May. On the global stage, an IMF team, led by Mr. James P. Walsh, visited Turkey from May 29th to June 11th, 2024, and shared their take. They predict that Turkey's GDP growth and inflation will both drop this year and next. Tight monetary and income policies are expected to dampen domestic demand, bringing 2024 growth to about 3.4%. Despite some positive effects from base numbers, Inflation will still be around 43% by the end of the year. On the bright side, the current account deficit should shrink to about 2.2% of GDP. Looking ahead to 2025, with tighter fiscal policies and positive real interest rates, growth is expected to slow to 2.7%, and inflation should ease to around 24%. In the longer run, if inflation continues to drop, confidence could rise, pushing growth back toward a healthy 3.5 to 4%. Export growth should keep the current account deficit steady at around 2%, and international reserves should stay comfortably above the IMF's safety threshold. Even more, Turkey's cautious approach to tackling inflation is like walking a tightrope. The goal is to avoid hurting economic growth too much, but this strategy comes with its own set of risks. Prolonging the fight against inflation means that unexpected shocks, like rising global energy prices, Middle Eastern conflicts, or the war in Ukraine, could throw a wrench in the works. Plus, a sudden change in capital flows could spell trouble. If inflation expectations are adjusted more quickly, these risks might be reduced. On the flip side, slower growth could increase credit risks, and borrowing in foreign currencies or engaging in risky trades could lead to liquidity problems. But here's a glimmer of hope. If inflation drops rapidly in late 2024, it could lead to lower inflation expectations and ease some of the price pressures. As Turkey deals with its tough financial situation, there's still hope for stability and a brighter future. This shift in Turkey's monetary policies might just be the beginning of a new chapter, offering a chance for a stronger and more prosperous era for the country. Don't forget to subscribe and like the video. Hit the notification bell to stay updated when we upload new videos. And if you want to continue exploring the different economic landscapes in the world, you might be interested in this video on the screen.